In this section, we will look at the EU Taxonomy disclosures of financial undertakings. We will start our journey from credit institutions. Banks are perceived to be the main lenders to fossil fuel companies. This is one of the main reasons why credit institutions are facing with the most extensive EU Taxonomy disclosure requirements. To discourage flows of capital to environmentally harmful sectors, regulators require banks to assess the level of greenness of their banking book assets and compute so-called green asset ratio. Similarly, banks should also calculate green asset ratio for their off-balance sheet items, including financial guarantees given and assets under management. Two other KPIs cover the taxonomy alignment of trading book as well as non-lending fees and commissions. In this course, we will focus on the calculation of green asset ratio for banking book assets. This is the core KPI of credit institutions. If you manage to understand banking book GAR, you will also be able to compute other KPIs. GAR ratio for banking book shows the proportion of banks' balance sheet assets that are aligned with the EU taxonomy. The denominator of GAR includes loans and advances, debt instruments, equities, derivatives. Numerator of GAR ratio consists of taxonomy-aligned loans and advances, debt securities, and equities exposures related to financial and non-financial undertakings that are subject to NFRD disclosures. The exposures to households who are retail clients of the bank and local governments are included in GAR numerator and denominator as well. Some items are excluded from the numerator of GAR ratio. This is because they are not treated as financing instruments for an asset or economic activity. Such items will include derivatives, cash, and other assets such as goodwill or commodities. These three categories will only be reported in the denominator of GAR ratio. Likewise, banks are not required to assess the taxonomy alignment of the exposures to non-NFRD and non-EU counterparties. This is because non-NFRD counterparties are not required to submit taxonomy disclosures. They will not report data that banks need to perform their alignment tests. So, credit institutions should only include those exposures in GAR denominator. Finally, trading book exposures to sovereigns and central banks are completely excluded from GAR ratio. Sovereigns and central banks are intentionally excluded from taxonomy KPIs due to a lack of appropriate methodology that could be used to evaluate environmental sustainability of sovereign entities. As we can see, quite a substantial number of banks' assets are excluded from GAR calculation. Therefore, the taxonomy requires to compute the proportion of total banks' assets that are covered by GAR KPI. Covered assets are assets that are included in the denominator of GAR. So, they are covered by GAR calculation. Here is an example. Suppose our bank has 20 billion in assets, and we need to compute the proportion of assets covered by GAR ratio. There is some additional information such as derivatives exposures, interbank loans, as well as central banks and sovereign exposures. We will firstly compute total GAR assets as a difference between total assets of the bank and all the assets that are completely excluded from GAR calculation. This includes trading book, central banks, and sovereigns. As a second step, we will divide total GAR assets by total banks' assets and arrive to 67% in covered assets. Now let's have a look at the reporting templates for credit institutions. There is a set of 7 templates that have to be prepared by banks. Templates 6 and 7 that cover trading book as well as fees and commissions are only due in 2026, while other templates are already due at the moment of this video. Let's examine the main template for covered assets, which essentially contains input fields for all the other KPIs of credit institutions. In this template, banks have to report gross carrying amount, eligible, aligned, transitional, and enabling amounts per product type, counterparty type, and taxonomy objective. Additionally, taxonomy-aligned amounts of loan and advances as well as debt securities with known use of proceeds should be disclosed. The template can be divided into 3 core sections. The top section covers the taxonomy alignment of NFRD counterparties, households, and local governments. The next section only displays the gross carrying amounts of the exposures for non-NFRD and non-EU counterparties. Derivative exposures, interbank loans, cash, and other assets that are not eligible under the EU taxonomy are displayed as well. Final section of the report covers the taxonomy alignment of banks' off-balance sheet exposures related to NFRD counterparties. The section includes 2 types of assets. Firstly, financial guarantees given by banks to NFRD counterparties. Secondly, assets under management related to NFRD counterparties, including debt securities, equities, and real estate exposures. In order to prepare taxonomy reports and calculate GAR ratios, we will need to test banks' assets for the taxonomy alignment. Regulators require banks to do this exercise twice, using the turnover and CapEx KPIs of banks' counterparties. Let's look at the practical example. Suppose Bank B granted a 1 million general loan to a company C. We want to know whether the loan is aligned with the EU taxonomy and to what extent. To do this, we will have to obtain turnover and CapEx KPIs of company C that we discussed in previous lessons. This data can be taken either from the EU taxonomy disclosures of company C that have to be publicly available, or from data providers such as Bloomberg. Let's do a practical example and use the turnover KPIs of company C. Suppose company C generates 30% of its turnover from electricity trades. Another 40% of its turnover comes from electricity production. And finally, 30% of turnover comes from transmission of electricity. So we can split total turnover based on 3 different NACE codes. The proportion of revenue linked to a NACE code that has a corresponding taxonomy activity will be taxonomy eligible. In this example, only 2 NACE codes that constitute 70% of total turnover have corresponding taxonomy activities. Therefore, only 2 revenue streams of company C are taxonomy eligible. Since the bank has granted a general loan, company C can use loan proceeds to fund any of its 3 revenue streams. That means the bank essentially finances only 70% of taxonomy eligible revenue. That's why the loan is only 70% eligible. In a similar fashion, we can compute alignment of the loan. Company C reports in the EU taxonomy disclosures that 50% of the revenue that comes from its nuclear energy business is aligned with technical screening criteria of the EU taxonomy under climate change mitigation objective. None of the revenue from electricity distribution business is aligned. Given this, only 20% of the loan is taxonomy aligned. This means that the bank loan only finances 20% of taxonomy aligned revenue of company C. Therefore, this loan is 20% taxonomy aligned. Finally, we will compute the amount of bank loans that finances transitional and enabling activities. Among three economic activities performed by Company C, only nuclear business is a transitional activity. Therefore, 20% of bank's loan, or 200,000 in loan proceeds, effectively finance taxonomy-aligned transitional activity. None of the three economic activities are enabling. That's why the enabling amount is zero. Here is a summary of our assessment results. These are the core metrics that has to be disclosed in the reporting template that we discussed in the beginning of the video. We computed the eligibility and alignment of the loan from turnover perspective. Now we will need to repeat the same exercise by using CapEx KPI of Company C. Suppose Company C wants to expand in renewable energy business. Therefore, 60% of its CapEx is dedicated to hydropower generation. This is essentially electricity production. The remaining 40% of CapEx aims to improve electricity distribution practices and increase the taxonomy-aligned portion of revenue that comes from this economic activity. I assume that the whole 60% of CapEx related to the expansion into hydropower business and the whole 40% of CapEx related to electricity distribution business are environmentally sustainable. Both of these capital expenditures can be considered as Type B CapEx. This is because Company C expands its taxonomy-aligned activities as well as turns some of its eligible activities into aligned. Given this assumption, we can compute eligibility and alignment of the loan under CapEx approach. CapEx KPIs will result in the whole loan being eligible and aligned. As you can see, the eligibility and alignment results are different for the turnover and CapEx approaches. That's the reason why regulators require credit institutions to compute and report two separate green asset ratios, a turnover-based GAR and CapEx-based GAR. Turnover-based GAR essentially shows the proportion of banks' assets that finance already green activities, while CapEx-based GAR shows the proportion of banks' assets that finance economic activities that can become environmentally sustainable in the future. Or in other words, the proportion of banks' assets that will help turn non-green activities into green ones. In the next video, we will go through practical example and calculate both turnover and CapEx-based green asset ratios.